Sorry, let's see. Sulu Co is a profitable company which manufactures sports equipment. Sulu Co uses net present value NPV when appraising new products projects and is currently appraising two investment decisions. Decision 1. Sulu Co has developed a new type of electronic stopwatch which claims is more accurate than any other currently available stopwatch. The development team have already put together a basic financial appraisal to justify manufacture of the stopwatch for the next 4 years. So a profit or loss forecast is given for the next 4 years. The above forecast figures include the research and development costs incurred to date totaling 200,000 which have been amortized over 4 years on a straight line basis. The production machinery for stopwatch will cost 600,000 incurred at the start of the first year of production and will have zero residual value at the end of year 4. Depreciation has been included in the above figures on a straight line basis over 4 years. Okay. Sorry. Suluco pays corporation tax at a rate of 20% and tax is paid at the end of the year to which it relates. So tax is paid in the same year. The machinery is eligible for 100% initial tax allowance in the first year of production. This has not been incorporated into the forecast figures. Solo has a nominal after-tax cost of capital of 12%. Okay, what is the second decision? Solo is also considering five other projects with the following details. Project is given, NPV is given. All five projects are divisible and not repeatable. None of the five projects can be delayed. Projects A and B are mutually exclusive. Due to hard capital rationing, finance for these projects is restricted to 2.1 million. The finance required for sorry, the finance required for the stopwatch project in decision 1 is not included in this constraint. Requirement A. For decision 1, calculate the APV of the stopwatch and comment on your results. 6 marks. Okay. So we have year 0 to year investment is that. So let's write down all figures in thousands. Investment amount is 600,000. Okay. Next one we need to have the cash flows. Need to have the cash flows. So let's take the profit before tax. Here the profit before tax, minus 75, 25, 105, 65. So for this profit before tax figures, we are going to make the adjustments and we are going to calculate the cash flows. Okay. So what are the adjustments which we have to make? Adjustments is first one for R&D costs. For R&D, research and development. So now this research and development cost which has been incurred is a sunk cost. That means you have already spent that money. Therefore, it is not relevant. So it should be. So in order to, so what have they done? The research and development cost totaling 200,000 has been amortized over the 4 years. They have amortized it, that is, they have divided by four and they have deducted it as an expense. So I hope you all know what amortization is. So if you want to reach the impact of amortization, you have to add it back. So 200 divided by 50. Next adjustment is the depreciation adjustment. So they have said the production machinery for the stopwatch project will cost 600,000 with zero residual value. Depreciation has been included in the above figures on a straight line basis. Okay, so we'll add that back. They have deducted depreciation, so we will add it. 600 divided by. Okay. Any other adjustments to be made? Any other adjustments? So what are the operating cash flows? Rather than doing this, directly we can take the taxation at 20%. So guys, remember, in FM, always the tax charge or the tax expense or the tax liability is based on the operating cash flow. It is not based on the profit. In certain times you might think it is based on the profit. No, it's not based on the profit. It's based on the operating cash flow. Okay, so equals sum. You get the operating cash flow, multiply it by 20. Next, tax savings. Working one. What is the tax saving? I mean, there is no working to be done over there. Okay, there is no working actually. Cut that, no need working. Can directly take it. What have they told? Sulu Co pays corporation tax at a rate of 20% and tax is paid at the end of the year to which it relates. The machinery is eligible for 100% initial tax allowance. You can highlight that part. You can highlight that. So what does that mean? So 100% means the investment amount, 100% of it. That means the full investment amount you will get the tax saving in year one itself. So usually what is occurring? Tax saving will occur each and every year until you dispose the asset. Year one, certain percentage, year two, year three, year four. For the entire 4 years, you will have tax saving. But in this question, in this scenario, then it is the all of the tax saving is occurring. The tax allowance they are giving you in the year one itself. Okay. So the full tax saving is occurring in year one. So as I mentioned when I was teaching also, be very careful with the tax saving. Because in different questions, they will give you different scenarios. Certain questions, year one, tax allowance is 50%, they will say. Tax allowance is year two, tax allowance will be 30%. Year three, no tax allowance. Year four will be tax allowance is 15%. So they can change the adjustment. So don't expect every single time they will give you the same type of adjustment. No, adjustments will change. You have to read, you have to understand, you have to make the adjustment. So this 600,000 amount which you are spending tax relief basically you are getting in year one itself. So 600,000 into 20%. How much is the tax saving? 120,000. Any other adjustments to be made? No other adjustments. We can calculate the NPV now. So net cash flows. rate PV equals in PV for the brackets where present here 1 to here 4 plus yes. What is the NPV? 48,300, 48,320. Okay, 48,320. Now, what did they ask? Calculate the NPV and comment on your result. Okay, always inside one requirement, two, three different things you have to do certain times. In this requirement, you have to calculate the NPV and give the comment. You have to do both things. If you want this full 6 marks, the full requirement should be addressed. Certain times I have seen, especially the mock exams which you all have done, certain requirements you are only doing half. They are asking you two different things. You have to do both. Then only you get the full marks. If you do half of it, you will get half marks. So you all are unnecessarily losing out on marks. Why? Because you all are lazy to read. Okay. So once you do the question, let's say you have done the question, you have done the requirement. Requirement is completed. Don't run and go to the next requirement. Once you're done, now, okay, calculate the NPV. Okay, NPV is done. Happy. Read the requirement once again. What are they saying? For decision one, calculate the NPV of the stopwatch and comment on your result. Here now you have understood, you have missed something. Comment is missing. So once you are done with the question, once you read the requirement once again, you will understand if you have forgotten to do something or not. Okay, so make sure that you are not missing out on easy marks. So a lot of students, what have they done? They are calculating the NPV, everything is correct, perfect. But comment is not there, advice is not there. So they are using one mark for no reason. So you know that, okay, what is the comment? Simply NPV is positive, accept the project. That's it. But you all are not reading. Therefore, you are losing that marks. So don't make these silly mistakes. Okay, so let's comment on it. What is the comment? Since the NPV is positive 48,328, Sulu Co should accept the project as it will increase share of the wealth. This is enough. Okay. So I have seen certain students when they ask to give you the when they ask to give the advice, when they ask you to give the comment, they write an entire paragraph, a huge paragraph, and like an essay. It's not needed. So remember, guys, for your advice, for your comment, you are getting 1 mark. So the amount of how much you are writing or the amount of time you are spending on that requirement should be based on the number of marks which is allocated. For 1 mark, you don't have to suffer so much. Okay. Simply, if you have what is the minimum amount which you have to write for 1 mark, you can say since the NPV is positive, Solar should accept the project. That is the minimum. What is the maximum? Maximum is what I have written over here. This is the maximum. More than this is unnecessary, completely unnecessary. Always keep in mind the amount of marks which are available. Based on the number of marks which are available, adjust the amount which you are writing, adjust the time which you are spending. Don't waste the time on questions which are giving you few marks. Understood? Fine. So we are done with this requirement A. Is this clear? Requirement A is okay. PV calculation is okay. Moving on. Requirement B. For decision 2, determine the optimal investment plan and its resulting in PV. Okay. So here, what have they given? Divisible projects, but there is a mutually exclusive project also. Project A and B are mutually exclusive. In such a situation, what will happen? How should you make the decision based on what? Let me take down the projects. Project, investment in BB. All figures are in thousands. Always mention this, okay? All figures are in thousands. Then only the examiner knows. If not, again, you will be unnecessarily losing out on marks if you don't mention this. Project, project A, project. So tell me, how do you all make the decision in this scenario? So until I write down, you all can type and tell me. Okay, see, I have directly excluded project C. Why? Because NPV is negative. We don't have to consider that. But if you are excluding it, make sure to write the note. Okay, so that examiner knows why you have excluded. If not, he will think you forgot to include it. So what I'm going to write a small note, we are going to say, okay, since project C has a negative NPV, it should be rejected. So we have mentioned, given a note. So now these are divisible projects. Therefore, we have to calculate the profitability index. We have to calculate the profitability index. What is that? NPV divided by the investment. Now we are going to rank the projects. What is number one? Which project is number one? E. Number two, B. Number three, A. Number four is. So if it's a divisible project and there are mutually exclusive projects, what should we do? We have to use the trial and error method. If we are going for project A, then what will be the total NPV? If we are going to project B, what is the total NPV? If project A is chosen, if project A is chosen. So scenario, we can say scenario. So capital, capital available is 2.1 million. Project. So we have to start with project D. We start with project D. What will happen? We have to invest 950. Remaining 1150. Once you are done investing in project D, we go for number two. Number two is B. But remember, B is A and B is mutually exclusive. But here in this scenario, we are choosing D. So we are going second one, second option, project 500. Remaining 600. So we are going for the next option, which is project E. How much are investing? $600 remaining $40. Can we do anything with these $40? No. There is no other investments which are available. No investments are available. So what do you do? We can just keep it. Next year we can use it. If you want, next year we can take this money and do something. As simple as that. It's not complicated. But now you will be thinking, oh, $40 is left over. What to do? Simply use it next year. Okay. Not a complicated thing. So total NPV in this scenario, what is the total NPV? We went for project E, then we went for project A, then we went for project E. We accepted the projects fully. Okay, fully we have accepted. Yes. Therefore, if we go for project A, if we choose project A, the first scenario, what is the NPV? 800 and scenario 2, if project B is chosen. So capital 2100. We are going to go ahead with project E. Why again? Because that is number one. So we have to choose project E first. Capital requirement is $950. What's left over? It's remaining 1150. Next, what is the next option? In this scenario, we are going with project B. What is the capital requirement? By 850. Remaining 300. So, what is number three? Number three is project A, but can we go for project A? No, why? Because it's mutually exclusive. We have chosen project B, therefore we have to forget about project A. So next option for us is project E, which is having a capital requirement of 600. We don't have $600, we only have 300. So whatever amount which is remaining, we are going to invest in and we are going to uh, the rest, we are not going to invest. We don't have money. It's a divisible project. It's okay. We can do that. What's left over, what's remaining? Nothing. So total NPV from project E, we are getting 400. From project B, we are getting 195. From project E, we are getting 300 multiplied by that profitability index. Project B 350. Project B 350. What did I take? Sorry. 858. Okay. Then what is your decision? Determine the optimal investment plan and its resulting NPV. So what should we do? The optimal investment plan is to invest fully in project E and B and then invest the remaining 300,000 into project E, as this would give you the highest possible NPV. Simple as that. Done. Is this clear? All questions are very easy. Section 3 is very simple. Simply you need to have this learn, have to have this understanding. If you had properly studied in the class, mutual exclusive projects, how do you do it? That same method, if you apply it, directly you can get the answer. So even in the class, when we were doing mutually exclusive projects, very similar question, extremely similar question. We had project A to project B, and only the figures are different. Other than everything else is the same. So if you all have properly learned in the class, you'll be able to apply it and get the answers. Students, not project, sorry. Requirement B, is it clear? Guys, requirement B is okay. So we move on, can we move on? Requirement C. Discuss two reasons why Sulu Co may be subject to hard capital rationing. Hard capital rationing, internal or external? Hard capital is due to internal factors or external factors. External factors. Very good. So give me two external factors which is resulting in people not giving money to Sulu Co. Give me two reasons or two factors. You just two examples, simply two examples. That's it. Think and tell me. Also, uh, high gearing better to avoid because even if you have high gearing, you can get no avoid high gearing. Lack of security collateral, we can say that. Okay. So first reason, lack of security or collateral, Tuluku might be having a lack of non-current assets to use as security or collateral, which results, uh, which results in it being unable to raise the finance which it needs. Investors and financial institutions. Anything else? Give me one other reasons. Limited funds. What do you mean limited funds, Shiva? Limited funds means internal problem, no? Like limited funds means inside the company there is no money. No one from outside is coming and taking your money, right? Stopping you from getting money. External hard capital rationing is due to external people. Now, lack of security collateral, because we don't have any security or collateral, outside people are not giving us money. Understood? Something like that. One more reason. We can say industry-wide factors. The industry which Sulu Co is operating in, which is the sports equipment industry, might be facing difficulties which results in investors not being willing. Right? Okay, that's enough. Okay, so these two factors are there. If you want extra, you can write down the track record of the company. Company is having a poor track record, or you can say poor management team or lack of track record. So these are certain additional factors you can describe. Okay, so in that requirement C is done. We have one more requirement, I guess. Next one. Discuss the usefulness of Suluco of using return on capital employed as an investment appraisal method. Okay. So again, when they ask a question like this, discuss ROC, discuss MPV, discuss IRR, it's always better to start with a general statement or a general description about ROC. Oh, that's all. Okay. We can say uh, return on capital employed ROC is a method which measures the objective capital employed. Okay. So what are the advantages? What are the disadvantages? What are the advantages of ROCE? Advantages of ROC, guys. Tell me certain advantages. Ah, okay, relative measure. Very good. Let's write down. ROC is a relative measure and therefore could be used to compare projects of different sizes with each other. Anything else? Simple to calculate. Okay, very good. ROC is not as complex, is not as complex as NPV and is therefore much easier to calculate and to explain to managers. Okay, you can easily calculate it and we can easily explain it also. What is the meaning of ROC? Okay, so with regards to that, we can also say that, uh, and it also uses readily available accounting information which can be easily obtained. Anything else? It uses total capital employed, but we can see using debt equity finance how much the incomes are generated. No. When you are talking about advantages, no, that comes as an advantage. And you can't say that's an advantage. We can say what else? ROC is also a widely used investment appraisal method. Investment appraisal method among analysts and companies. Finally, we can say ROC also takes into account, yes, full life of the project. ROC also takes into account the entire life of the project. That's the final advantage. Okay. Next, disadvantages of ROC. What are those disadvantages? Yes, ROC uses profits and not cash flows. Very good. You can say, before that, we'll talk about the time value for money. ROC does not take into account the time value of money, does not take into account the time value of money, say, and takes into account profits and not cash flows. Therefore, ROC is not a method which is directly connected to the increase in share of the wealth, like in the okay, its ROC uses which is dependent on the company's accounting policies and can be manipulated later. Unlike cash flows, it is an inferior method where we and IR. Any other disadvantages? Any other disadvantage? We can say since ROCE is not an absolute measure, it does not give a definitive investment signal, but has to be compared to target ROCE in order to reach a decision. Fine. So that. Any questions, guys? We are done with this requirement. We are done with uh, this requirement is done. We are done with this question also. Okay, so 20 marks, very easy.